Whether you knew it or not, we're going to tell you the clock is ticking on the so-called Bush tax cuts. And if Congress doesn't extend them, they'll expire at the end of the year. So what does that mean exactly for you? Joining me right now, financial expert Ron Hart. So, Ron, good to see you.
Good to see you.
So a couple of things, a couple of scenarios that could transpire. If you make, say, a family of more than $250,000, it means certain itemizations might be going away as a result of this. Or perhaps you enjoy that $1,000 credit for your one child. Maybe you'll only enjoy half of that. What are some of the other scenarios that could mean bye-bye Bush tax cuts?
Taxes are going up pretty much for everybody. On the lower side, from 10% to 15%, a 50% increase. On the upper end, 35 to 39.6% marginal tax rate, which will be a pretty big boost going back to the old Clinton era tax rates.
So this impacts everyone. This is not, most people associate these, Bush tax cuts with the kind of upper echelon of the moneymakers out there, the wealthy, but this really could be pretty sweeping. It could impact a lot of people.
At a very vulnerable time in the economy as well. Spending is important to the economy. The consumer part of the economy is a big part of our growth and the way we're going to come out of the recession. So it's an inopportune time, but they felt like that's what Obama wants to do. So that's what they're going to do.
So what are some of the things that you can do to perhaps protect yourself, particularly protect your nest egg, your retirement nest egg?
Right now, you can defer expenses into next year. Try to take as much income in 2010 as you can, to the degree you can control it. If you have an LLC or a private company, do that. If you have a bonus, try to take it 2010, not 2011. You try to, the Roth IRA situation is probably the most visible and the most topical way to take advantage of the situation right now.
And in what way? Because a Roth, you have to kind of qualify. You can't make but so much money in order to enjoy a Roth.
They're lifting the adjusted gross income limits on that.
So anyone's open to it?
Yeah, you can convert your IRA to a Roth. You have to pay the taxes is the bad part, but you get all the future income and growth tax-free. And
what is this about potentially locking in a rate, a tax rate, so to speak, for your IRA or for your Roth? Possible?
Possible. You can pay taxes on the current tax rate of 35%. We know it's going probably to 39.6%. But most importantly, it grows tax-free. And in the future, when you pull your money out, it's not taxable. So you pay tax one time, and you're done with it.
And that's pretty perfect because, by the time you retire, the last thing you want to do is now pay taxes on all that you have been saving for so many years.
Exactly. Another big factor is the estate tax goes from 0 to 55% this year. And a quirk in the system because of the 10-year budgeting cycle, it's an oddity, but it's 0 this year. So if you're wealthy, and your kids are at your house, January 31st, sleep with one eye open.
Okay, now what do you do about these conversions? What do you do with your 401k? You're happy the way things are going right now. Is now a time to start fiddling with it?
Each firm advisor will have a model. They can take your facts and put them in a model and tell you whether it makes sense to convert or not. It's going to be costly. You have to pay the money now, but you either pay now or you pay later. The presumption is that tax rates will go higher. The only quirk is that if you're older and you don't have as much time to compound the money tax-free, it doesn't make as much sense to you. So for young people, it makes a lot of sense because you got a long time to grow your money and not pay taxes, and the tax burden is less. If you're older, close to retirement, 59 or so, you probably will be careful about doing it. You want to look at it really hard.
Any real catches here?
Just paying the taxes. You have until October 15th. If you change your mind to convert back, you can change and then come back if you see you don't want to do it. But you're trying to guess what the government's going to do in future tax rates, and it's kind of a hard thing to do.
And speaking of guessing on what the government may do, I mean, there is a pretty good likelihood, or maybe I should just say there's a chance that Congress would say, we're going to extend these. We're not going to allow it to expire.
Doesn't look likely right now. They may do it at the lower end, the 10 to 15% lower bracket. They may say that's not going to happen. But the truth is 1% of America pays 40% of the taxes. So all the money comes from the top end as well. So almost half of the Americans don't pay taxes in federal level. So the burden's always been on the higher income taxpayers. And the 35 to 39.6. And the most damaging thing, I think, to the stock market potentially is the fact that dividends are going to be taxed from 15% now to 39.6%.
Wow.
That's a pretty major move. So you have to think about dividend-paying stocks and what that means to you, and you got to pay a lot more taxes on it. So, and as people look to invest in America and look to grow the stock market out of the doldrums, they're going to think about things like that. Taxes matter. LeBron. Yeah. I think he chose Miami because it's
no state taxes.
Zero.
Right,
$100 million. He makes $100 million in New York City. He'd pay $13 million in taxes. In Miami, Zero.
God, that is
and
tremendous,
LeBron is
isn't
a
it?
businessman, right?
Right. Well, he said that, and I remember seeing that in that interview before he made his announcement
Sure.
that, you know what, I understand.
He
that
understands.
Every franchise, it's a business.
Exactly.
And that's how
Taxes
you
matter.
make these
They
decisions.
really do.
All right. Thanks so much, Ron Hart. Good
Good
to see you.
Take care.
Excellent.